Are we on the verge of a financial storm? In the last year and a half, Jeremy Grantham, a renowned financial guru, has been sounding the alarm not once but twice. Now, for the third time, he's speaking out, even though he typically avoids interviews. Jeremy Grantham, co-founder of the massive GMO LLC asset management firm, which oversees over $100 billion in assets, is an 84-year-old powerhouse. His age doesn't slow him down, and he looks amazing for his years. But it's not his vitality that makes him headlines, it's his dire predictions. As a seasoned observer of market bubbles, Grantham is warning of a looming recession. He believes this downturn will last well into 2024, indicating that it may be an extended ordeal. To add to the intrigue, he suggests it might even kick off in 2023, causing ripples across the financial landscape. But what does this mean for us? Well, according to Grantham, it spells trouble for asset prices, including the stock and possibly even the bond market, which has already been under stress. The implications are clear. Brace yourself for turbulent times ahead. Jeremy Grantham has a track record for foreseeing financial crises, like the dot-com crash in 2000 and the 2008 financial crisis and the 2021 tech bubble. Now once again he's sounding the alarm, and it's time to pay attention. Grantham disagrees with the Federal Reserve's recent optimism, as they claim the recession is behind us. He's skeptical of their track record, asserting that they've never correctly predicted a recession, especially the ones following major financial bubbles. Moreover, Grantham isn't a fan of how Chair of Federal Reserve Jay Powell has been dealing with inflation. He suggests that the recent success in controlling inflation is beyond Powell's control, and he sees inflation remaining higher than the average of the past decade. In essence, Grantham's forecast suggests that we're likely heading for a recession, possibly starting in 2023, with ongoing repercussions into 2024. The recent tech bubble may not have completely deflated, and there's a smaller bubble emerging in artificial intelligence. Why do people always seem to fall for these bubbles? It's human nature. People see the stock market surging, and they fear missing out on something big. It's that irresistible temptation of watching your neighbors get rich that drives these bubbles. In essence, it's human psychology at play. Let's break down the impact of rising interest rates on mortgages and car loans. In an interview, Jeremy Grantham talks about interest rates having surged from 3% to over 7%. Here's what it means for those looking to buy a home. When interest rates rise, your purchasing power for a home decreases. In simple terms, 2 years ago, you could afford a $375,000 house with a 3% interest rate. But with rates now over 7%, your affordability drops significantly. This is a significant blow for potential home buyers. The outlook for interest rates isn't optimistic. The interview suggests that rates are unlikely to decrease soon, as there is a consensus that they will continue to rise. This isn't good news for the economy or for people trying to buy homes. The interview also touches on car loans. The average price of a new car is now around $50,000, and with interest rates on the rise, car loan payments are increasing as well. Payments for car loans are averaging about $800 a month, with some people even paying over $1,000. For people who need loans to buy cars, these rising rates are concerning. The surge in interest rates has significant implications for the housing market, making it harder for people to afford homes. It also affects the affordability of new cars, impacting people's finances. The interview suggests that these trends aren't likely to reverse anytime soon, which is a cause for concern in the current economic landscape. The housing market's soaring interest rates present a challenged situation for potential buyers. One option for buyers facing this dilemma is to consider adjustable rate mortgages, which provide an initial period of lower rates, offering some temporary relief. However, this comes with the trade-off of less stability and the uncertainty of future adjustments. Some people are willing to take this route, essentially dating the rate while committing to the house purchase. They might plan to refinance down the road when rates are more favourable. Nevertheless, it's important to note that the traditional 30-year fixed-rate mortgage is generally considered the best gauge of affordability. Betting on refinancing carries risk, especially if rates don't move as expected or if unforeseen circumstances arise, such as a job loss or the need to sell the house. Moreover, home builders and sellers are attempting to ease the burden on buyers by offering incentives like rate buydowns to soften the impact of high interest rates. In a recent podcast interview with Mike Wilson from Morgan Stanley, he discusses the overvaluation of the stock market and its potential impact on the economy. Wilson highlights that earnings are not keeping pace with stock prices, resulting in elevated valuations, especially in the context of rising interest rates. As a response to the post-Federal Reserve meeting and the rise in rates, equity markets have exhibited significant reactions, possibly reflecting a shift from a higher for longer perspective to a late cycle economic backdrop. This transition is supported by market internals, with factors like high-quality balance sheets and defensive sectors outperforming cyclicals. In the current economic landscape, higher interest rates are starting to take their toll in several ways. One of these is a preference for defensive sectors in the stock market. These sectors, like utilities and consumer staples, are seeing different valuations based on their absolute multiples. Utilities are trading at 16 times earnings, which is relatively cheaper, while consumer staples are trading at 19 times earnings, making them relatively more expensive. Nevertheless, when compared to historical and market averages, both utilities and consumer staples are at cheaper end of the spectrum. Healthcare, which has slightly higher relative valuation, is still within the bounds of historical norms. Overall, valuations for defensive sectors remain reasonable, making them attractive in the current climate. On the other hand, there are challenges for consumer discretionary stocks. The technical aspects and market breadth of these stocks are under pressure, reflecting a slowdown in consumer spending. Various factors contribute to this, including rising delinquencies in certain households, increased gas prices, and weakening housing sector data. Economists are even forecasting negative real personal consumption, expenditure growth in the fourth quarter, with a subdued recovery after that. The travel and leisure industry, which has been a bright spot, might also be losing its shine. Furthermore, credit card interest rates are hitting record highs, with rates of 20% or even higher. For those who carry credit card balances, this is a significant burden. When making payments, a substantial portion often goes towards interest, leaving only a fraction of the principal balance. With approximately $1 trillion of credit card debt in the US, this issue is far from disappearing anytime soon. This presents additional challenges for people who are already struggling financially. The economic landscape is becoming increasingly complex, with rising interest rates affecting various sectors, including housing, consumer spending, and credit card debt. The situation is far from ideal and warrants careful consideration for those affected by these changes. Inflation is hitting hard, affecting items from the gas pump to the grocery aisle. In July, personal expenditures surged 3.3% from a year ago, leading to higher expenses for pharmaceuticals, recreation, groceries, and clothing. Amid these financial challenges, more people are resorting to credit cards, which carry high interest rates, 26.6%. As a result, many individuals struggling to pay their credit card bills. Despite the record levels of credit card debt, Americans continue to spend, with July seeing a nearly 1% increase from the previous year. The situation raises questions about whether the Federal Reserve will raise interest rates further as a measure to combat inflation. For investors, keeping up with these economic factors and market developments is paramount. It's vital to stay well informed and adapt investment strategies when needed. Jeremy Grantham expressed concerns about parallels between current market conditions and previous financial crisis. Let's get into the specifics of these incidents more clarity. In 2000, there was a significant explosion in prices of technology stocks, which was followed by a sharp crash. This led to substantial losses for investors and the bursting of the dot-com bubble. In 2008, there was a painful decline in the US housing market, which nearly caused the collapse of the banking system. This triggered the global financial crisis. Grantham draws parallels to Japan's experience in the early 1990s, when they had simultaneous bubbles in both stock and real estate markets. This led to a prolonged period of economic stagnation and is often referred to as Japan's lost decades. He is concerned that attempts to burst bubbles in both the stock and real estate markets simultaneously could have dire consequences, as seen in Japan's history. Grantham's warnings highlight the potential risk of excessive speculation and inflated asset prices in both the stock and real estate markets. What are your thoughts on this matter? Let us know your thoughts in the comments section. Thanks for watching.